Okay, so right now, something huge is happening in our cities, but you might not even notice it. There's this quiet, but absolutely massive disruption reshaping our skylines. And it's not about new skyscrapers going up. No, it's about the value of the ones already there coming down hard. All right, let's get into it. Get ready for this number, $413 billion. According to a major study from NYU Stern, that's the estimated long-term loss in value for U.S. office buildings. That is just a staggering amount of wealth that's seemingly vanishing from the balance sheets of our biggest cities. So, that leads to the big question, right? How on earth did a simple shift in where we all work lead to a crisis this big? Because it's not just about empty cubicles, it's about a fundamental change in our behavior colliding head-on with a wall of financial deadlines. Let's break that down. To really understand this nosedive in value, you have to realize it's not just one thing. It's more like a perfect storm. It's a classic case of a double whammy hitting the commercial real estate market at the exact wrong time.
So on one side, you've got this cultural shock, the work-from-home revolution. I mean, it permanently changed the demand for office space. But then, on the other side, you have a financial shock, something called the maturity wall. And that's just a massive pile of debt that building owners have to refinance in a completely different and much tougher economic world. Let's tackle that work-from-home piece first.
The pandemic, of course, was the trigger. I mean, look at this. Office use just fell off a cliff. But the really crucial part is that it never fully bounced back. And why is that? Well, because companies realized they could function, and in many cases actually thrive with hybrid and remote setups. That historic link between work and a physical office was fundamentally broken.
And this chart really lays out the consequences perfectly. If you look at this data from that NYU study, you can see a direct connection. Those bars on the right, the ones for fully remote and hybrid companies, they show a much bigger drop in the need for office space compared to the in-person companies on the left. This isn't just a theory. It's a measured, significant drop in demand.
Okay, now for that second shock, the financial one. It's called the maturity wall. The easiest way to think about it is this. A huge number of building owners took out loans years ago when interest rates were super low and every office was full. Now, all of those loans are maturing, which just means they have to be paid back or refinanced, and they're all coming due at pretty much the same time. So this creates a really nasty financial trap. Picture this. An owner's loan comes due, but interest rates now are way higher, which makes getting a new loan way more expensive. At the exact same time, because of remote work, their building is worth less and it's bringing in less rent. So the bank looks at the numbers and basically says, yeah, no way, we can't refinance this. The owner is just stuck. And this isn't some problem for the future. It's happening right now. According to data from PB Mars, the amount of distressed commercial real estate, buildings in that exact trap we just talked about, recently hit $116 billion. That's a 31% jump in just 1 year. The maturity wall is here. So we've got this massive financial trap. But what's really interesting is that it's not hitting all buildings the same way. In fact, it's creating this huge divide in the market. It's a phenomenon that analysts are calling the flight to quality. This quote from the NYU Stern report really nails it. A stranded asset. That's something that has lost its value so completely that it might never, ever recover. And that's the risk facing thousands of older, less than glamorous office buildings all across the country. Now, these two charts from the NYU study really show this trend in the data. Look at the one on the left. Before the pandemic, that's the blue dots, you can see that rents went down as buildings got older. Sure, that makes sense. But look at the red dots, post-pandemic. That drop is so much steeper. The newest buildings are commanding a huge premium, while the older ones are just getting hammered. And the chart on the right tells a similar story for high-quality versus low-quality buildings. The gap between what companies will pay for the best of the best versus, well, the rest is getting wider and wider. And the logic here is actually pretty simple. If you're a company and you're trying to convince your employees to actually commute into the office, you want that destination to be worth the trip, right? The office isn't just a place to work anymore. It has to be an experience. And companies are voting with their wallets, paying top dollar for those premium spaces and just abandoning the average ones.
So why should any of this matter if you don't own a skyscraper? Well, because the value of these huge buildings is deeply tied to the health of our banks and, maybe even more importantly, the funding for our cities. The ripple effects here are potentially enormous.
You can break it down into two major risks. First, there's the risk to the financial system. That NYU study points out that U.S. banks are on the hook for about $2.4 trillion in these loans, so widespread defaults could really stress the banking sector. And second, there's the risk to our cities. Commercial property taxes are a huge source of money for things we all rely on: schools, police, sanitation, you name it. And this leads to a really dangerous cycle that experts have a pretty scary name for: a fiscal doom loop. Here's how it works. Empty, devalued buildings mean less tax money for the city. So the city has to cut services, which, makes it a less desirable place to live and work. That causes even more businesses and people to leave, which lowers property values even further, and the cycle just keeps going. Let's use a real-world example to make this concrete. Take a look at New York City. In 2020, over half of the city's entire budget came from real estate taxes, and just shy of a quarter of that massive total came specifically from office and retail buildings. So you can see, when the value of those buildings plummets, it blows a gigantic hole in the city's finances. So, with this perfect storm brewing, what can anyone actually do? Well, this whole crisis is forcing building owners and investors to stop being passive landlords and start becoming active strategists. They have to adapt to a reality that is permanently, fundamentally changed.
Analysis from PBMRs actually highlights the strategies that seem to be working. The proactive owners are diversifying their portfolios. They're working with their lenders way early to find flexible financing options. They're managing their properties much more actively, and they're running stress tests for all kinds of different economic scenarios. They are not just sitting around and hoping for the best.
And really, the main takeaway here is that the old model of just owning a building and collecting rent checks is pretty much over. The winners in this new era are going to be the ones who are adaptable, who make their decisions based on data, and who are constantly planning for what's coming next. Survival now requires real strategy.
And all of this leaves us with one final question to think about. The next time you look up at the skyline of your city, you're not just looking at buildings anymore. You're really looking at a live experiment in adaptation. Some of those towers are going to be transformed for a totally new future, while others, well, they might just become monuments to a way of working that's already in the past.